The depreciation of China's currency is unsettling markets all around the world and raising questions about the future of economic growth in China. This is Steve Wiseman at the Peterson Institute for International Economics with Nicholas Lardy, Senior Fellow at the Institute, to discuss this phenomenon in the second week of August. Nick, first of all, what are the prospects for China's economic growth in the wake of this sudden depreciation?
Well, as you mentioned, the critics are saying this proves that China's growth has been much slower than the advertised headline number of 7%. And this depreciation is kind of a last desperate gasp to boost growth by increasing exports. I think the evidence in favor of that is actually fairly weak. The Chinese economy has been on a fairly stable footing. I think if the goal had been to offset, to boost growth, they should have devalued 2 years ago, and they should be doing it by much more than 1% or 2% or 5%. So it doesn't really fit the facts. And beyond that, when you start looking at the arguments, the critics are really overlooking the fact that the growth model has changed in China. The service sector is now the driver of growth. So the fact that industrial growth has slowed down quite a bit does not mean, as it would have meant 10 years ago, that the economy is falling off a cliff.
So China has been, though, the biggest performer in the world in terms of economic growth. It's almost like people are desperate for signs to see it sputter. I mean, a month or two ago, the stock market was going down, and everyone thought that was a sign that China's growth is slowing down. What accounts for this misinterpretation, do you think?
I think a couple of factors underlie this. I mean, first of all, it is now the second biggest economy. So everyone's intensely interested in what's happening. Is it speeding up, slowing down? Is there going to be a collapse? Is the hard landing around the corner? Because it'll have a dramatic effect on commodities and currencies around the world, and a lot of people are trading on that kind of information. So there's an intense focus on what's happening. The second problem is that people are using old metrics to try to figure out what's going on, like industrial growth. The service sector is now driving growth. It's retail sales, and beyond retail sales, it's all the expenditures on services, which aren't counted in the retail sales number. The other related problem is we don't get very timely data on what's happening in the service sector. The Chinese publish monthly data on industrial growth, and so people latch onto this to try to figure out what's going on, but we have to wait for quarterly data on what's the real growth in the service sector. So the data is not similar. People are relying on the old data, which used to be a fairly good indicator of what was going on. That's changed, but they don't have a new, real-time number to look at. And so I think a lot of people are going off in the wrong direction, misinterpreting what's actually happening.
Well, Nick, you wrote on the China Watch blog on the Institute website that this depreciation is driven by market forces and not by manipulation, or so it appears so far. Why are those market forces driving the currency downward?
Well, the market has been driving the currency downward for 6 or 8 months, but the central bank has resisted that in two ways. First of all, every day they set the fixed parity, which is the starting point for trading. They put it back up to the level it was the day before. And then when it trades down during the day, they have a 2% band. So as the currency weakens towards the edge of the band, they've been selling dollars, that is buying up domestic currency to keep it from weakening beyond the 2% band. This has been going on month after month after month. So the underlying pressure for depreciation has been there all along. And what they did on August 11th was to say, we're going to take these market forces into account when we set the starting point for trading every day. And that's exactly what they've done.
So the whole world has criticized China for its supposed manipulation of its currency. But now that China is letting market forces determine the currency, and what you just said, the world seems to be, or some, especially trade hawks in Washington, seem to be criticizing China for letting market forces determine the currency.
Well, some of us have been saying for months to people that say they should have a more market-determined exchange rate, I said, be careful what you wish for, because it's almost certain that the currency would depreciate if the government allowed market forces to really have an effect on the exchange rate. And that's what we're seeing. The question now is, how long will this go on? It's gone on for 3 days. The cumulative depreciation is getting close to 5%. Are they going to intervene more to keep depreciation from going further or not? They've embarked on, I think, a sensible policy of allowing the market to have a greater role, but it's also a very risky strategy because, as we all know, these kinds of financial markets can overshoot. Once the anchor of this fixed exchange rate has disappeared, then a lot of market participants are asking themselves, I wonder how much more the currency will go down. And they want to get in front of that move, so they sell right away as much as they can, and that could lead the currency to overshoot and go to a much weaker level than would be justified by fundamentals. So it's, I think, a good move on their part to let the market play a greater role, but it's a somewhat risky strategy because the transition from where they have been with a lot of intervention to a situation in which the market will play a greater role and ultimately there'll be less intervention is a very difficult transition.
Final question, which is, what does this tell us about the Chinese prospects for including the renminbi in the basket of currencies under the IMF's category of special drawing right?
Well, I think on balance it will be positive. Whether or not it'll be enough to push them into the plus category as opposed to the reject category, obviously we'll have to wait and see when the executive board meets in November. But the Chinese have done what the IMF has been asking for, that is to have a more market-determined exchange rate. The IMF has also said they think the currency is no longer dramatically under or overvalued, say roughly fairly valued. So they certainly were not calling for depreciation or appreciation. If the depreciation went on for a long time and got much bigger, it could become a negative factor.
Thanks, Nick.
Thank you.